Hello, everyone. I'm Carrie Brandon Elliot, a contributing editor at Tax Notes International, and today we kick off a series of webinars on COVID-19 and emerging markets, coordinated by the International Tax and Investment Center. The ITIC is an independent research and education organization that since 1993 has focused on tax and investment reforms in developing countries to improve the investment climate there. They've coordinated a series of 8 papers offering tax policies to emerging markets during post-pandemic recovery, and Tax Notes International will be publishing those 8 papers over a 2-month period that's ongoing right now. We'll also be participating in a series of webinars between now and January. The series is called Post-COVID-19, How Government Should Respond to Fiscal Challenges to Spur Economic Recovery, and it presents measures to pursue and options to avoid so that governments in emerging markets can raise revenue without harming growth and investment. Today's featured paper was published in Tax Notes International on September 7, and it's called Coronavirus, Fiscal Challenges for Emerging Markets. It was prepared by Oxford Economics, which is a leader in global economic forecasting, analysis, and consulting. Today's guest is Adam Slater, who's a lead economist and strategist at Oxford Economics. He spent over 10 years analyzing a wide variety of developing and industrial economies. Today's paper has been described as a macroeconomic scene setter of the fiscal implications of increasing debt loads in emerging markets. Coronavirus has caused a massive negative impact on economic output, and it's expected to result in large budget deficits and increasing public debt loads. The paper calls for a balancing act between fiscal instability and economic distress, which could spill over into social and political unrest. And with that, I'll hand it over to Adam.
Hello, everybody. I'm going to share my screen so we can see the slides. As mentioned, the title of the presentation is Fiscal Challenges for Emerging Markets. And there are 4 main sections which can be seen on the first slide here. We're going to ask first what the fiscal challenges are which the coronavirus crisis poses for emerging markets. We'll then talk a little bit about the global economic backdrop. Moving on then to talk about how the crisis might impact emerging markets and advanced economies in different ways. And finally, we're going to talk about the fiscal implications of the coronavirus crisis, specifically for emerging markets. So to start with, let's just talk about what's happening to the world economy in a broad way. Coronavirus and the measures that are being taken to tackle it have exacted a pretty heavy toll on world GDP. We expect world GDP to decline over 4% this year, which would be worse than in the global financial crisis a decade ago, with the slump concentrated in the first half of the year. In emerging markets, we expect especially large declines in the non-China area. Now, a key factor behind these big drops in output is the impact of social distancing and lockdown policies on consumer spending. About 40% of consumer spending is in sectors like tourism, hotels, restaurants, cinemas, clothing, automobiles. That is sectors which a lot of consumption takes place normally in crowded or social situations. Now, much of this consumption has been lost or postponed. And some months ago, we had a little look at how big the impact of this sort of social distancing might be, with some simple scenarios which are presented on the slide which is in front of you now. And what we found that, for example, a 3-month lockdown could lead to consumption in these sectors falling by 15, 25, even 30%, depending on how strictly it was obeyed. And that is pretty much the sort of numbers we've now seen in the empirical data as well. As well as consumer spending suffering badly in this coronavirus crisis, we've also seen a negative impact on world trade. There have been double-digit declines in goods trade already seen in the data, and even steeper drop in services trade due to the collapse of tourism, air travel, and similar sectors. For 2020 as a whole, we now expect world trade in goods and services to drop by between 10 and 15%, which will be at least as bad and quite possibly worse than in the global financial crisis. So that sets the scene in terms of the negative backdrop that we've got. Now, how do we think there are differences between advanced and emerging economies? Well, there are several areas where we think there are key differences. It's risky to generalize too much because emerging markets are a rather diverse group of economies, but we can point to a few key points. First of all, weaker healthcare infrastructure in many emerging markets. We'd also highlight demographic differences. For example, most emerging markets have younger populations, but at the same time, some emerging markets tend to be less internationally connected via air travel and via large cities. We find that in emerging markets, there tend to be rather limited financial buffers for firms and households, and also social security systems. There are structural economic vulnerabilities in EM, which involve things like commodity and tourism dependence, reliance on capital inflows, and a high reliance on foreign exchange debt. Often a lack of fiscal space to react to the coronavirus crisis in emerging markets. And finally, pretty social conditions worth mentioning. In many emerging markets, there are overcrowded urban areas and poorer general health, which may affect the path of the virus. Just looking at one or two of those areas in detail, one thing that is interesting on the employment side is that emerging markets tend to have very high levels of informal employment, often more than 60%. This means, first of all, that lockdowns can quite quickly lead to widespread hardship, especially in the context of limited social security systems. But it also means, perhaps more subtly, that it may be hard to enforce or maintain lockdowns and social distancing policies. Also worth mentioning that as well as limited social security systems, there tend to be rather limited financial buffers, such as savings, private asset holdings in emerging markets. Now, if we think about healthcare and demographics, we see an interesting pattern. Emerging markets tend to have fewer hospital beds, doctors, equipment, etc., than advanced economies. And this means that the virus risks overwhelming healthcare systems. However, emerging markets also tend to have younger populations who are somewhat less at risk of severe symptoms. So these two factors kind of balance each other out to a certain extent. And indeed, we find there's a negative correlation between the two factors. So, for example, young populations in places like Nigeria and the Philippines coincide with rather poor levels, relatively speaking, of health provision. And by contrast, health provision in Eastern Europe tends to be quite good by the standards of most emerging markets, but they have older populations as well, which increase the risk. So the riskiest places you would point to would be places where you have both relatively weak health systems and older populations, and they would include places like Chile and Peru and Thailand. Now, in terms of structural economic vulnerabilities, there are a number of these which might mean that emerging markets are particularly vulnerable to the negative economic environment we find ourselves in. Some emerging markets are heavily reliant on particularly hard-hit sectors like tourism and commodity production. For both of those sectors, export earnings have dropped quite sharply. They also tend to have weaker communications infrastructure, for example, broadband internet, which makes working from home harder. It may also mean that firms find it harder to use online methods to organize deliveries and supplies. We find that these vulnerabilities vary quite a lot across regions, but broadly speaking, Latin America seems to have particularly high levels of vulnerabilities, and emerging Europe the lowest level. Another vulnerability is that many emerging markets tend to rely heavily on foreign capital inflow to finance current account deficits, to finance investment more broadly. And there's been a strong outflow of financial capital from emerging markets since the crisis began, worse in fact than in the global financial crisis. Now this risks leading to a variety of negative outcomes such as rising borrowing costs, squeezed liquidity, lower growth and government revenues. And as I mentioned before, a lack of fiscal space is a potential issue too. Early fiscal intervention can help curtail the costs of pandemics. We see that from past studies. Now for the G7 economies, government bond yields have fallen rather significantly during the crisis, which has given the G7 countries quite a lot of fiscal space to intervene. But the extent to which this is true for emerging markets varies. Overall, there's less fiscal space because emerging markets have lower fiscal credibility, less investor tolerance for high deficits and debt, and often initially higher deficits too. In terms of what's actually happened to bond yields since the crisis started, for some emerging markets, bond yields have actually gone down as they have in the G7. India is an example there. But for others, you've found that bond yields have gone up, and South Africa and Turkey particularly stand out there. This slide kind of brings together all these different elements into one table, and you can study how some of these different risk factors look across different countries and different regions. Overall, the most worrying region, probably Latin America, where we see limited fiscal space and quite a lot of structural vulnerabilities, and emerging Europe probably best placed, despite the fact that there are some risks from its relatively elderly population. But there's quite a lot of variation between within the regions as well as between them. So, for example, within Latin America, some economies look much more vulnerable than others. Uruguay, for example, looks not too bad on some of the measures, whereas you have higher vulnerabilities in places like Argentina. Okay, so move on to the fiscal consequences now. Well, deep recessions will push up budget deficits sharply this year. There'll be lower government revenue, there'll be higher social spending, and also there are emergency programs in place in many places to try to backstop household incomes and sectors which have been forced to close down or have been operating at low capacity. Worldwide, we think that the cost of coronavirus fiscal support measures that's been announced is roughly 5% of world GDP, so a pretty substantial amount. In general, packages have been larger in advanced economies than emerging economies. This reflects a couple of things. First, the issue of lower fiscal space, which we mentioned already, although the oil-producing countries are a bit of an exception there. But also because some emerging markets actually need these backstops less. Some of the economies are not as credit reliant, therefore they don't need to have large credit guarantee schemes. In some cases, lockdowns have been shorter or less costly due to different demographics. So the necessity for large support measures has been lower as well. So in some respects it's good, some respects it's bad. And because of the smaller social security systems we mentioned earlier, there are lower what we call in economics automatic stabilizers in EM. Government spending doesn't rise automatically with weaker growth in the way that it does in advanced economies. So you get less spending pressure from that side too. So in terms of the actual numbers, revisions since last December have been substantial. In our forecast, the median deficit for emerging markets is now expected to be 6% of GDP, around there, and quite a lot of emerging markets will have deficits over 10% of GDP this year, which is a pretty substantial size. And as a result of the large increase in deficits this year, government debt will also increase significantly. This slide shows our projections to 2023, and it's based on our baseline economic forecast. And it's important to note here that our baseline forecast assumes that economic activity picks up quite quickly from 2021 onwards. So a lot of the damage is done in year one, if you like, in terms of the rise in the public debt ratio. What we find is that the median public debt ratio for emerging markets will rise to about 54% of GDP by 2023 in our baseline forecast. That, as a median ratio, still looks broadly manageable, not on its own something that would cause a dramatic fiscal crisis. However, if we look along the axis here, we can see that for quite a few economies, public debt ratios are going to be a lot higher than that. We've got economies like Argentina, Pakistan, Brazil, South Africa, Egypt, where public debt ratios are in the region of 80 to 100% of GDP by 2023 on our forecasts. And that's more the kind of level which you would be concerned about fiscal stability over the long run. Now, one piece of good news for emerging markets, I think, in terms of fiscal space and more generally the policy response to coronavirus, is that we were a little concerned at the start that there would be, because of the capital outflows and global risk aversion, there would be pressure for emerging markets even to put interest rates up, or at least it would reduce the space for them to come down. But what we've actually seen in practice, that despite generally lower policy credibility than the advanced economies, a lot of the emerging markets have been able to ease monetary policy since the crisis began, to a greater extent even in the global financial crisis. And this makes fiscal interventions easier. Some emerging markets have even actually been able to experiment with quantitative easing, though not to the extent as in the advanced economies. Notwithstanding all of that, there are several EM for which we think significant financing pressures are possible in the next year or so. If we look at this chart, which shows maturing debt and deficit, which altogether equals the total financing need, we see that there are economies like Brazil, South Africa, Hungary, Ukraine, where the total financing need will be over 15% of GDP this year, which is a challenge. And even where you can finance this via local bonds or the banking system, there is a risk that in doing so you crowd out the provision of capital to the private sector, with potentially negative medium-term impacts. Now, another issue in respect to fiscal sustainability is that a lot of emerging markets rely quite heavily on foreign purchases of local debt to finance their budget deficits. And we can see here that countries like South Africa, Mexico, Indonesia, Colombia, Poland have all been in that group. And there is a challenge here to replace these inflows in a world where global capital flows are more depressed. Once again, the same point from the previous slide is that even if you can do this by turning to domestic sources, that does risk a crowding out effect. Now, at Oxford Economics, we have something called a sovereign risk indicator, which brings together a whole bunch of different macroeconomic indicators, financial indicators, to produce an overall indicator. And using forecast data, we can have a look at what's going to happen to this score in various emerging markets in the near future. And what we find is that factors like rising deficits, debt, inflation are going to have quite big impacts on the sovereign risk indicator for a number of emerging economies. We can see on the left-hand side here the biggest rises in risk are in some of the Middle Eastern countries, Oman, Egypt, UAE, and also Brazil, Nigeria, and Croatia. Overall, emerging markets governments face something of a balancing act between trying to avoid fiscal efforts which are seen by markets as unsustainable and which therefore can spill over into financial instability, and preventing economic distress which spills over into social and political unrest. Now, the danger of the latter is borne out, I think, by the correlation over recent years between GDP disappointments and the rise of populist political movements. You can see it on the slide here, where GDP disappointments are at their biggest on the left-hand side and the smallest on the right-hand side. And you can see that quite a lot of the countries on the left-hand side have seen political unrest of one sort or another. So to wrap it all up, major fiscal risks for emerging markets from coronavirus crisis. There are key structural differences in advanced economies. Mostly these add to risk, but in some cases they actually mitigate them. The rise in deficits and debt will be substantial this year, but it looks mostly manageable if our forecasts for a strong recovery from 2021 onwards are correct. Market tolerance may be tested in a few cases. Now, one optimistic point, I think, is that although emerging markets have suffered quite big capital outflows, they have been able to loosen monetary policy more than might have been expected, and that has eased the fiscal situation too. But nevertheless, as mentioned in the slide before, there is still a tricky challenge here between balancing fiscal credibility with other key goals, including the real economy and public health. And that concludes the presentation.
Thank you, Adam. That was great. Now it begins sort of the question and answer part of the program. But while we wait for some questions, if between the time that you've prepared the data and today's webinar, if you have any additional updates or anything to add that has happened, say, over the last couple of weeks.
Yeah, well, probably a few things worth mentioning in that respect. We start to see more data coming out from the emerging markets about the actual path of recovery from the coronavirus recession, if you like. And what we see is really quite varied patterns. For example, if you look at Latin America, we see a very strong looking recovery in some sectors in Brazil, but a really rather lagging one in Chile by comparison. And this reflects to a large extent quite different policy approaches that the two places have taken. So we do see that kind of interesting heterogeneity, if you like, developing in some of the incoming data. We also see that one of the issues we highlighted about how effective lockdown policies might be in certain situations in emerging markets due to social conditions and so on. Emerging evidence from places like Peru and Argentina is that these policies perhaps haven't been terribly effective, and therefore they may have to be revisited. And also perhaps on the optimistic side, although the data here is scant and not entirely reliable, from Africa, which we might have been concerned about, I think, in terms of the risk from social situations, from social conditions rather, sorry, and from lack of fiscal space and some of the other structural factors, the outcomes don't seem to be quite as bad as we feared. In particular, public health outcomes don't seem to be as bad as we might have feared. So there's some interesting bits of data coming through, and I think that'll continue to inform how these various factors which we identified actually turn out to be important in practice.
So now we have a few questions coming in. The crowding out effect. Isn't that less of a concern? I would assume that countries will do whatever is necessary in terms of monetary and fiscal policy and not worry one bit about crowding out. Am I wrong? Do you have any thoughts on that one?
Yeah, I mean, I think in the sense that you don't worry too much about allocative efficiency in disastrous situations, that's fine. I think we'd all agree with that. With regard to emerging markets, crowding out is a little bit different to how it is in advanced economies. in advanced economies, you usually think about crowding out as being something that operates through interest rate changes, really. In emerging markets, the effect can be rather more direct, in the sense that in very thin financial markets, if you take a large chunk of the credit resources available to the private sector away and move them into another area, you can get quite a quick and direct impact on real activity from that, rather than a sort of slow burning one by different interest rates, which you might expect to get in advanced economies. So it is more of an important issue in certainly in some emerging markets, especially the poorer ones, than it would be in an advanced economy.
The follow-up question to that is, what is the natural limit on quantitative easing? The speaker mentioned credibility. Can we explain that a bit further?
Yeah, I mean, essentially, if you can do quantitative easing without raising long-term inflation expectations in particular, and you can keep on doing it, then there's no obvious, monetary limit to what you can do, as long as you can keep that that environment in place. And what we find for the advanced economies is that since the start of this year, quantitative easing has obviously been done on a pretty substantial scale, and we haven't seen much of a movement in long-term inflation expectations. So it's been shown that you can actually do it, perhaps on a larger scale than people would have imagined in January or February. And it's also been visible that it's actually happened in a few emerging markets too, without as yet at least any particularly negative outcomes. However, I think it's worth reiterating that QE in emerging markets has been done on a much more limited scale, and has tended to be done by some of the economies like Chile, where there's already perhaps more policy credibility than there would be in somewhere like Argentina. In Argentina, I think the consequences of monetary deficit financing are still pretty negative, and that hasn't been changed by the coronavirus crisis.
Do you have any thoughts on potential? Oh, I'm sorry. Do you have any thoughts on potential ripple effects on developed markets?
Well, yes. I mean, insofar as emerging markets are now more or less half the world economy, and more on some measures, if they recover slowly, then developed markets will suffer themselves as a result of that in terms of lower external demand. If, on the other hand, they recover faster, then obviously that's a positive. So that's one obvious ripple effect. I mean, the other potential ripple effects are through financial distress. I mean, so far, fingers crossed, we don't see an awful lot of that. Only really one or two places where we could point to where there are significant problems, and none of those are likely to spill over at the global level right now. So the biggest effect probably right now is through the real economy channel.
So we've got another question. How will pockets of political unrest further affect the economic recoveries in particular countries? The last week saw Armenia, Azerbaijan, and Kyrgyzstan have breakdowns of sorts. Any thoughts on that?
Specifically on those countries, I don't have anything of detail to add, but clearly the general point is that if we have political unrest, social unrest, it's a negative for economic recoveries. Not only because it creates uncertainty, it creates precautionary saving, it creates capital outflows. It can affect consumption patterns, investment patterns, all these kinds of things. So it's clearly a negative.
And that's followed by a more broad question of, will other countries see a rise of political unrest, either from internal or external forces?
I think the longer the crisis goes on, the more likely that is. There are quite a lot of places you could point to which have underlying political problems, have of various sorts already. the crisis threatens to create quite a lot of poverty, which is always a potential catalyst for unrest. It also threatens to deteriorate social conditions more generally. I think I'm going to point to any one or two places where this is likely to happen. I think that would probably be unfair on my part, but it's clear that the longer it goes on, the more risk there is of this sort of thing materializing. Yeah.
One final question. Do you see a role for the IMF or the World Bank in managing through any of this?
Yeah, I mean, in a sense, that's already happened. The IMF has provided financial support to some places, the World Bank similarly. If we're in a situation of depressed capital flows, and that, especially that lasts, beyond this year into next year, that's the year after, then the role of these international organizations in filling that gap to some extent is going to be an important one. And obviously, particularly so for the very poorest countries and for those who have the largest economic and financial imbalances.
Well, I think that wraps it up unless we have any more questions out there. Thank you, Adam. It's been great.